Good morning, everybody. Thanks for joining me today. It's January 29th. Again, I always seem to comment on the weather and on how time flies when you're having fun. And it's certainly, here's another January. It's just about over. We got, I guess, a day or two to see how the January effect plays out. But here in Long Island, the weather's, well, it's kind of like the market. It's not doing much. It's not sunny. It's not raining. It's not cold. It's just kind of a blah day. So far, it's a blah day in the market, which is actually pretty impressive given the geopolitical news, which is pretty awful. It was very awful over the weekend. Not only is the war between Hamas and Israel continuing with lots of casualties, but the Iranian proxies in the Middle East continue to harass and now actually kill and wound numerous servicemen in northeastern Jordan. So there's going to be a reaction clearly from the administration, and the question is whether this kind of back and forth continues to accelerate and create more problems. Washington seems to be concluding that we've been too nice to the Iranians, and now it's time to get tougher. So it's kind of puzzling that the Iranians are stirring things up right now. I would imagine that they would have wanted to have a few nuclear weapons in their holster before they started all this taking these aggressive moves in the Middle East. But then again, they are often called, I call them the mad mullahs. Who knows what they're thinking? And they certainly they're full of themselves in terms of thinking that they're going to be a major regional power, and that the Shiites will rule the Sunnis, and so on and so forth. Anyways, the Middle East has always been an area of conflict and geopolitical crises, and so we have another one now, and yet you wouldn't really know it from the price of oil. It's come up some, but it certainly hasn't spiked up. I think that's because one way or the other, the oil is going to get out. One way or the other, demand for oil is going to remain relatively muted as China's economy remains depressed and as Europe continues to be in a shallow recession. Well, meanwhile, the U.S. is doing fine. And then, of course, while there's been a lot of headlines suggesting that electric vehicles are kind of losing their mojo, the reality is that we have had probably enough substitution already that demand for gasoline has had some impact on the demand for gasoline. Well, as we look ahead here, clearly the one of the bigger events is going to be what the Fed does on Tuesday and Wednesday, particularly what Fed Chair Powell says that the Fed's going to do. Most likely they will do nothing at this meeting, but all eyes and ears will be on Powell to see what he says is the inclination of the Fed to do next. The markets have been building in an expectations for 5, 6, 7 rate cuts. I think those expectations have been throttled back somewhat by the strength of the economy. But, over the past couple of years, we've had a fairy tale kind of story about how things might actually work out reasonably well. Fairy tales can come true is the title of the morning briefing today. And as it turns out, the data that's recently come out certainly suggests that at least for 2022 and 2023, it did turn out to be a fairy tale. The question is, where do we go from here in 2024? And we'll get to that in a minute, but you kind of know where I'm standing on the outlook, which is relatively optimistic. No recession, inflation continues to moderate. But let's think about how Powell sees it from his perspective. I think he has a chance here, a choice possibly, of determining whether the next few years, the rest of the decade, is going to be like the 1920s, so the roaring 2020s. He might also be instrumental in determining whether instead of that, it turns out to be something more like the 1990s. And then, of course, there's another possibility, and that's the 1970s. The Fed usually doesn't pay that much attention to geopolitical developments, but they got to be attuned to what's going on right now, and that is that the crisis in the Middle East has the potential for creating a second energy crisis. We had an energy crisis in 2022 when the Russians invaded Ukraine, and now there's a potential for another energy crisis if the Straits of Hormuz get disrupted, blockaded, if the Middle East situation gets far worse. And in that scenario, oil prices would go up, and we've kind of learned here that it takes credit crunches to cause a recession, and if we don't have a credit crunch, we don't have a recession. We did have a spike in oil prices at the beginning of 2022, and that didn't really cause a recession, though there were actually negative numbers for 2 quarters in a row in the first and second quarter, but that never made it as an official recession and never will, because of the underlying strength of the labor market and so on. So the situation right now is potentially similar to the 1970s. And so does Powell really want to start lowering interest rates here, suddenly to be hit with oil prices going up a lot, creating another inflation spiral, and then suddenly having to reverse policy? That's one possibility. Again, I think the oil market's telling us that things could maybe continue to get crazier in the Middle East, and yet we're not going to necessarily see that kind of story. But, we have to be realistic, and it's certainly a realistic possibility. How about the 1990s? Well, again, if everything continues to work out hunky-dory, as we used to say, and the economy is doing well, the Middle East situation remains fairly contained, we don't see it having an impact on the price of oil. In that scenario, if the Fed starts to really go from being hawkish to being dovish, and signals that they are that they are very excited about how inflation has come down, they start to not necessarily say mission accomplished, but to say that a lot has been achieved, and if inflation continues to moderate, then they'll continue to lower interest rates because they don't want real interest rates to go up. Well, that could be 1990s all over again. Irrational exuberance could make a comeback. We're already seeing a tremendous amount of interest in technology stocks. They've done extremely well, particularly the big cap stocks, which is deja vu all over again with the 1990s. Back then, the big stock, the big company turned out to be Cisco. This time around, looks like NVIDIA is going to be the leader in what could turn into irrational exuberance. I wouldn't say right now it is irrational exuberance, but the multiples aren't exactly cheap for some of the bigger cap technology kind of names. So Powell must know all that, and does he really want to get everybody all excited and get another speculative bubble? So instead of an inflation bubble, he'll have an asset bubble, and then he'll have to worry that the asset bubble is creating a positive wealth effect, stimulating the economy, and might be able to bring price inflation back. And, oh, by the way, the Middle East could blow up. So that's another scenario. And then my favorite scenario, and still my base case, is the 1920s all over again, the roaring 2020s. And in that scenario, productivity makes a comeback. The economy gets a boost from productivity. Unit labor cost inflation drops close to zero. Inflation continues to decline. By the way, I'm thinking, well, what happens if inflation actually drops below 2%, down to zero? Are the Fed officials going to obsess about, go wacky again about deflation and say, oh my God, we've got to get inflation back up to 2%? I hope not. I hope we've learned something from the misbegotten policies of the past several years, but who knows? These are all macroeconomists, and they tend to be kind of strange. I know that because I'm a macroeconomist. Actually, I shouldn't say that. I'm not that strange, am I? Anyways, back to the show here. So we're talking about the 2020 scenario, and in that scenario, the stock market should be going higher and will be going higher. We still have 5,400 for the S&P by the end of 500 by the end of this year. It doesn't look all that wild an idea as it did when we first put it out, and talking about 6,000 by the end of next year. But along the way, there'll be volatility. I don't think we're going to have a recession this year. I don't think we're going to have a recession in 2026. I think the economy will continue to grow, and that should be a positive for the markets, with the big story being productivity. Well, let's go take a look at some charts here that relate to this story. This is the morning briefing charts for fairy tales can come true. That's the topic of the morning briefing. And certainly looks like the fairy tale has become reality here. We've got real GDP up 3.3%. It was up more than that in the in the third quarter of last year. So for all the talk about a recession's coming, instead we had the economy not only not have a hard landing, it didn't even have a soft landing. It just didn't land. It just continues to grow. And you can see that final sales are solid as well. This is the year-over-year percent change in real GDP, and you can see that we're up solidly at 3.1%. During the period between the great financial crisis and the great virus crisis, we were growing around 2%, and the naysayers were saying 2% is the rate at which the economy stalls and you fall into a recession, and they were wrong about that. We monitored a lot of panic attacks during this period that we said that these panic attacks will pass. They're not going to cause recessions, as was on a regular basis. I think we came up with something like over 70 panic attacks. I'm going to update that because I think it might be relevant again. So economy is doing just fine. And one of the reasons it's doing fine is because lo and behold, it may very well be that our productivity story, which is driving our roaring 2020 scenario, may already be showing some signs of appearing. So unlike the Godot recession, our productivity story may be showing up here. And so as you can see, we had a big increase in productivity on a quarter-over-quarter basis. It was 5.1% during the third quarter. It was 2.4% during the second quarter. Now, what's going to be in the third quarter? Well, it looks like it's going to be pretty good. Real GDP is up over 3%. Aggregate hours worked is basically up. It is up 0.4%. So we should have something between 2.5% and 3% growth in productivity during the fourth quarter of last year. I mean, 3 quarters in a row of productivity growth exceeding 2%, exceeding 1% is pretty good. It's quite good. Here, by the way, is a snapshot of the aggregate of real GDP. As you can see, it's been on a nice upward trajectory here. And this is aggregate hours worked. We have it now through the fourth quarter, and it's been relatively flat. Real GDP was strong. So when we get the productivity numbers reported on, I think the productivity numbers are coming out Wednesday, or they're coming out this week, that's for sure. And I think the productivity numbers are going to be a pleasant surprise. And so should unit labor cost inflation. Unit labor cost, as we've discussed before, is the underlying inflation rate. 70% of costs in our economy are related to labor. And notwithstanding all the strikes and settlements that seem to be very inflationary, it just isn't adding up to an inflationary scenario for unit labor costs. Productivity is justifying some of these gains. And some of these gains are for a fairly small percentage of the labor market. I think something like 11% of private payrolls are unionized, whereas back in the 70s it was at least 35%. So that's an important distinction, though. Clearly, if the union workers are getting big increases, that has a demonstration effect to other workers, and it can spread. But so far, that's really not the case. And as I said, the productivity numbers, if they keep going like this, will allow for real wages, nominal wages to rise faster than prices. That creates purchasing power. So if the main reason we're getting a productivity boom is because there's a labor shortage, especially of skilled labor, then real wages can increase, which provides a purchasing power to the consumers to keep on spending. And life is good. So a few more good things here. This is the unemployment rate versus the PCED inflation rate. This is basically the Phillips curve, and it has in the past shown an inverse relationship at times between inflation and unemployment. So that's, I think, where economists went wrong over the past couple of years, is they basically had a Phillips curve mentality that in order to bring inflation down, we would have to have the unemployment rate go up. And the unemployment rate's been stuck below 4% now for over a year, and yet inflation's come down, as you can see from this chart. We can see the same thing here when we look at unemployment versus wage inflation. Same story. There's been, in the past, regular inverse correlations between these two variables, but it's not an iron law. There can be an environment in which a tight labor market stimulates more productivity, and that productivity growth does a lot of magic things. It's sort of the magic wand. It's the elixir. It's the fairy dust. Just to be consistent with my story here, that makes things work out much better than the pessimists predicted. This is the unemployment rate versus the productivity growth cycle, and that kind of is my critique of the Phillips curve. The Phillips curve just shows two variables: the unemployment rate versus the inflation rate. And what I'm pointing out is, wait a second, there's another variable here, productivity, which needs to be taken account of. And as you can see, there is an argument to be made that that when unemployment is going down and the labor market stays tight, and that there is an incentive for companies to increase productivity, and that correlation shows up there as well. So there's something to the Phillips curve. There's something to this magic of productivity and its relationship to the unemployment rate and what that does to create more growth. One of the major positive impacts of productivity growth is real wages. So productivity numbers come out quarterly. They tend to be revised. There's a lot of controversy about how it's measured and all that. You know what I've always said: if the numbers support my story, it's great data. If it doesn't support my story, there's something wrong with the data. It'll be revised and so on. Anyways, that's an old trick for forecasting. You can try it at home. Can't hurt anybody. So here you're looking at average hourly earnings, which is a monthly measure of wages. And we have two measures. We've got for all workers, and that data started sooner than this data that's available more historically for production and non-supervisory workers. They account for about 80% of the labor force, so you're counting a lot. But this tends to be what clearly is lower wage workers, and this is higher wage workers would be boosting this number, as you can see. And so when you adjust it for inflation, you can see that this nonsense that's been bandied about for years, that real standards of living and real pay has been stagnant for decades, it's just wrong. You can see that was the case during the 70s, during the 70s and the 80s, when we had deindustrialization and we were shipping a lot of our manufacturing overseas. But you can see that since the mid-1990s, productivity has been in an upward trend of roughly 1.5%. And notice that it's kind of real wages have been on an upward trend of 1.5%. And you can see that it seems to be actually picking up some. So I view this as a useful monthly indicator of whether productivity is making a comeback or not. Let me take a swig here of some water. So all this adds up to real wages are increasing. We saw that in the real wage numbers, real wages and salaries numbers that are in personal income. So this is real wages and salaries, all-time record high. You can see that other sources of income, unearned income, I mean, it's earned, but not by rolling up your sleeve and digging a ditch. It's interest, dividends, rent, and proprietor's income. Proprietor's income, arguably, is in fact, income for people who are working hard, maintaining their businesses. People like myself and others. So we're working stiffs, and this whole sector of the economy is huge and often ignored in terms of its impact on so-called income inequality. A lot of it has to do with more people have their own businesses and are doing relatively well. Well, we won't get into that subject at this point, but real disposable income looking awfully good. So again, this is kind of a fairy tale scenario come true. This is real consumer spending. So for all the talk that consumers were going to retrench because they're going to run out of excess savings, that doesn't look like it's working out too well. The idea that student loan payments were picking up and that would cause the consumers to retrench in the fourth quarter, that didn't work out too well. Um, and you got to know your consumers. And the reason I know them so well is because members of my family are really good consumers. What can I tell you? And I get the bills. So it does provide me with an insight. And another insight we've had that's actually worked out nicely is our insight on inflation coming down. And you can see, I think we actually started in the second half of 2022 giving you these kind of numbers, saying that this is kind of the ranges we saw that PCD inflation falling down to, and we haven't changed them. And so it's working out real well here. And we got to go them down to 2 to 3% by 2025. And now I'm thinking to myself, well, what happens if it drops below 2% and these wild and crazy people at the Fed start getting all obsessed about deflation again? Well, we'll address that problem if and when it happens. So inflation's worked out well the way we expected. We did expect to see a spike in goods inflation. We did think a lot of that was transitory, and a lot of it was related to supply disruptions. So we've gone for goods inflation, which is durables and non-durables, from over 10% down to zero. We've pointed out in the past that when you go all the way back to the 20s, inflation tends to be spiky. The faster it goes up, once it peaks, it tends to drop just as rapidly. This was the aberration. This was the 1970s, where we had two spikes in inflation, and we were coming down pretty nicely here, but we got hit with the second energy shock. Also, monetary policy started to screw things up again over around here. So the service inflation rate, which Powell focused on the non-housing, he said, look, we know housing is a laggard here, and it's still a laggard, but on a year-over-year basis, it's coming down. And that's actually going to help us for the next several months, because it should continue to come down as goods inflation remains near zero. Meanwhile, the so-called super core inflation rate, this blue dotted region, Powell was concerned that it was stuck at 5%. Well, now, hooray, we're down to 3.3%. So that even that sticky inflation rate has come unstuck. So that's my happy story for you today, but a balanced one, I think, indicating where the risks lie with regards to the geopolitical situation in the Middle East, and of course where they lie in terms of a potential for the Fed to create an asset bubble. I have no problems with asset bubbles. My only problem with it is then it puts me and you in the position where we have to figure out when to get out, and then what do we do with our portfolios? So I'm rooting for a civilized bull market here, 5,400 end of year, 6,000 by the end of next year. Some panic attacks along the way, but all in all, a steady course. So let's go look at. Let me put on my other glasses here. Let's go look at some of the cues that I might give you A's on. So who are you rooting for in the Super Bowl? Well, I guess I don't know. I'm not rooting for either side. So, I'm just going to be there's betting parlors now where you can bet on how many times they'll show Taylor Swift. So maybe I'll play that game, but it should be a pretty exciting game. Is it possible that the Trump and Biden China tariffs caused some inflation along with onshoring and greedflation? If so, might the productivity gains continue to offset the inflationary pressures? I was never a big believer in greedflation. That's because I think we still have a relatively competitive economy. And while there might have been some greed propping things up, the reality is we did have a modest earnings recession as a result of a profit margin recession. So profit margins did get squeezed. It's not as though companies just willy-nilly were able to raise prices faster than their costs. It looked like we had a fairly traditional but short wage price spiral. Actually, it was a wage price rent spiral, but the productivity is magic. If we are going to get that kind of magic growth in productivity, and I'm talking about going from a year-over-year rate of something like 1% up to something in the neighborhood of 3 to 4%. Sounds like the Ardennes getting delusional again with this far-fetched stuff, but that's actually consistent with history. History shows that when productivity growth booms get going, they peak out around 3 to 4%. And I'm being conservative here because they really peak out more like 4%. And that would be amazing for productivity. It would be amazing for real wages. It would be amazing for keeping inflation down. It would just be one heck of a fairy tale. Let's see if it comes true. Okay, that was Joel. Okay, Drew. Looking at past rate cuts, it seems that the SPY drops substantially when the Fed is cutting, and so it doesn't seem smart to DCA, at least not now. Therefore, I wonder what would be a reasonable strategy for someone trying to get back in the market this year. Yeah, well, the market never is terribly accommodating. When we want to get back in, it doesn't give us that opportunity. When we want to get out, it takes us out at the bottom. At least, again, I got some relatives that are great at calling market bottoms. Maybe that's why I've had such success at it, because they always call me at market bottoms and ask me if they should get out. And that tips me off that that's the bottom in the market. And it worked again this time. So I love those relatives. They've helped me forecast. But look, I'm thinking that this notion that stock prices go down when the Fed starts easing, it's true historically, but that's because again, people don't really have a sense of history here. What really happens historically is the Fed tightens. The tightening causes an inverted yield curve because investors start to figure that if the Fed keeps going much higher, something will break in the financial system. And it turns out they were right. And so it was okay to buy a bond at 4% when the 2-year was at 5% because, the 2-year went a little bit higher. And then, boom, we had a financial crisis. We had the banking crisis in 2023. And then we get a credit crunch, and then we get a recession. So it's true that the Fed's rate goes up and peaks before recessions, or just as recessions are starting, because the impact, it's not really a long and variable lag. It's really has more to do with credit crunches. This time around, the Fed came by very, very quickly and stopped the credit crunch with a liquidity facility for the banks. And that kept that scenario from playing out. And so far, we haven't had anything really break in the credit system. And now that credit conditions have eased, and by the way, I should have mentioned that in my discussion of Powell, he's mentioned before that the Fed is looking at the Fed funds rate relative to inflation. But first and foremost, they're looking at financial conditions. And financial conditions, I mean, the spread between the high yield bond, corporate bond, and the 10 years down 200 basis points since March of last year. They kind of spiked up on that mini credit crisis, banking crisis, and it's now down 200 basis points. So I think Powell's going to have to signal. He doesn't have to do anything that I say, and maybe it's just my opinion, is that he shouldn't lower rates. He shouldn't signal that they're in any rush to lower rates. He should say that financial conditions have eased, and that may make the Fed think twice about lowering the Fed funds rate. And if productivity is making a comeback, doesn't that imply that the neutral real interest rates may be higher now? Not one of my favorite concepts, the neutral real interest rate, because I can't measure it, can't see it. Okay, Brian, you gave me too long a question, so just email it to me and I'll try to address it. Let me try to address some of the shorter ones. What are your thoughts on investing international versus the U.S.? I'm probably going to overstay my welcome in recommending overweighting the U.S. I've been recommending that since 2010, stay home rather than go global. I still wouldn't invest in China. I know that they've had a bounce here with their interventions in the stock market, but their economy is not doing very well. India's had a huge move already. It's already discounted a lot of the notion that what China loses, India gains. Though, that there are certainly reasons to be optimistic about the economy in India. I don't know much about Indonesia and Malaysia. South Korea and Taiwan have their opportunities, but the geopolitical risks may be something you want to consider. Frankly, I think overweighting the U.S. Still makes sense. And if you're not comfortable with valuations in the mega cap 8, I think the SMID caps are still providing an opportunity here. They had a nice run, then they give back a lot of it on a relative basis. But if we're not going to have a recession and the Fed's not talking about raising interest rates, I think the SMID caps are cheap. Gus, is the Fed forced to lower rates if inflation continues to see a rapid decline so that real rates will be reduced? I think that's really the big issue, is like how things have changed, right? For the past couple of years is how much higher is the Fed going to raise interest rates? When are they going to get to a restrictive level? And now the real Fed funds rate is about 2%, and they've basically said they think it's restrictive enough. I'm not even sure why. I guess they're saying it's restrictive enough because inflation's coming down. I mean, the economy looks like it's doing really great, so it's certainly not restricting the economy. But now that we're looking at rates coming down, Fed officials have said that they might have to consider lowering the nominal Fed funds rate if inflation continues to come down, because otherwise the real Fed funds rate goes up. Now, by the way, it's like, I don't know, I like to ask questions that said, who came up with that concept, the real Fed funds rate? We're talking about an overnight interest rate that's adjusted for a year-over-year inflation rate. And what exactly does that mean exactly? I think there's more to inflation adjusting the bond market, 10-year bond yield or corporate bond yield. But the concept of a real Fed funds rate just doesn't make much sense to me. But if it makes sense to people at the Fed, I've got to factor that into my thinking, if that's the way they're thinking. So I think Powell at his last press conference, I looked at it, the last press conference, he said that they would have to consider lowering the Fed funds rate, but he also said, but we also have to factor in general financial conditions. And right now, general financial conditions are really easy, as I just said. No particular rush to lower the Fed funds rate. I'll take this last one. I believe you've been recommending an overweight to energy. Do you feel more comfortable with that recommendation today, given the increasingly tenuous geopolitical tensions? Or are you thinking the economic struggles in China, EU, decline in EV demand, and continued strong production in the U.S. will keep a lid on the prices in energy stocks? Good question. Yeah, I mean, I think energy, first of all, it's a tiny sector in the S&P 500. So when one says overweight energy, if you have 5, 6, 7, if you have 10%, you've got a major position in energy relative to the S&P 500. So it doesn't take much to overweight energy, but I would overweight energy as nothing else as a hedge against calamities in the Middle East that might finally have an impact on oil prices. Meanwhile, the energy companies have been responding to the climate activists by cutting back on their capital spending and paying out more in dividends and buying back their shares. So yes, I think energy should be overweighted, but let's put it in the context of it being an awfully small sector. And meanwhile, we've been recommending technology, which in my mind has always included communication services, and that's about 45% of the market cap of the S&P 500 is now in technology and communications. Well, it should be a very interesting week. Have a good one, and let's do this again next week. Thanks for tuning in.